Well, David, it's Sarah, and I just wanted to follow up on that, the expansion that is underpinning the earnings growth and your bull call and everything like that. I'm stuck on this big red headline that we're flashing. 911,000 fewer jobs created in the 12 months through March than we expected. So that's pretty moderate job growth leading into this slowdown that we're seeing. Can the economy still expand in a labor market that we have like this, given what we're learning about the past year?
Well, that would be consistent with the Goldman Sachs economics view. The 3 Fed cuts from now to the end of the year, another 2 cuts in the first half of next year. So that's a tailwind for some of the companies in particular with high magnitude of floating rate debt, therefore lowering their interest expense. Your question about whether that would be a headwind for some of the economic growth, yes, that would certainly be a story there, which is why the observations about the industrial or the, if you will, tech capex is so important. Sarah, for that to persist is a source of demand for both revenues for these companies and for earnings. So while the underlying economics is certainly a concern, the earnings thus far have been pretty robust. You have earnings expectations that we have around 7% earnings growth for this year, another 7% for next year. That is a recipe for earnings-led extension of the bull market as opposed to valuation. The market trades at 22 times earnings, so it's a pretty expensive market historically on an absolute basis, unlikely to get a multiple expansion meaningfully from these levels.
Finally, David, speaking of the rate picture, your boss, David Solomon, at the Barclays conference, it just doesn't feel to me like the policy rate is extraordinarily restrictive when you look at risk appetite. And is there I imagine there's a robust discussion about the Goldman House view.
Well, within the research department, the view is that the Fed is likely to cut, trying to balance the dual mandate, and the idea of the weakening, a little bit weakening labor market would suggest the Fed is going to cut in the next week.
Right, but everything else that David's referring to, spreads, risk appetite, and all that?
Well, there's certainly been a lot of risk on in the market overall, and certainly credit spreads are very, very tight, and so that's undeniable as a variable.
Right.
The IPO market, return of that, or the reopening of the market is another big area, a source of sort of risk on, if you will, in the market, and that's sort of a good thing from a fundamental perspective.
Yeah, and we'll see what we get from PPI, CPI next couple of days.